Welcome, this is IGTV, here to help you trade the FOMC announcement at the top of the hour and the markets following the release. Let's take a look now at the headlines ahead of that decision today. It's widely expected that the Fed will be cutting interest rates by 25 basis points, but the big question is, what about the accompanying statement? Ahead of the announcement, the dollar is trading just off the highs of the day, and equity markets continue to trade near their recent record highs as third quarter earnings surprise on the upside. Well, now, the Fed's raised interest rates 4 times back in 2018, but has taken a more cautious approach to monetary policy this year. This time around, the Fed's expected to cut interest rates by 25 basis points, the third cut this year. In terms of economic data, as a backdrop, the US unemployment rate is currently at a 50-year low. There have been sharp declines in the private payrolls. That's the ADP number, which came out today at 125,000. This was as high as 260,000 reading back in January this year. The forecast for the October NFP, that's the government jobs release this Friday, is 85,000, with average hourly earnings figure watched closely by the Fed to come in at 0.3% month on month, and the unemployment rate 3.6%, up from last month's 3.5% reading. We'll be live on Friday when the NFP is released at 12:30 p.m. UK time with Victoria Scholar and Peter Dixon from Commerzbank. Meanwhile, the Fed's preferred measure of inflation, that's the PCE number, which was also released today, shows the advanced third quarter-on-quarter number was 1.5% against a 2% reading that was expected, down from 2.4% in the second quarter. However, the core PCE, that's excluding food and energy, was 2.2% against an expected 1.9% reading and a 2.1% figure last month. Now, in theory, these numbers show that inflation is meeting the Fed expectations, not including the more volatile food and energy prices. And the latest GDP reading, which was the first look at the third quarter today, was at 1.9%. That was higher than the forecast of 1.6%, but still the second worst number recorded for Donald Trump's presidency. President Trump is also keeping up the pressure on the Fed Chairman Jerome Powell on Twitter. In Trump's latest post, he quoted a Fox News show, Varney and Company. This is what he said. Over in Europe and Japan, they have negative rates. They get paid to borrow money. Don't we have to follow our competitors at Varney Co? Also, he added, yes, we do. The Fed doesn't have a clue. We have unlimited potential, only held back by the Federal Reserve. But Trump also says we are winning anyway. So what will the Federal Open Market Committee do today? Markets are pricing in a 93% chance for the Fed to cut interest rates by 25 basis points. Well, joining me here in the studio here in London is IG Chief Market Analyst Chris Beecham with his thoughts. What have we got in terms of a trade to watch in today's expected move?
I think Eurodollar is fairly interesting as we head into this meeting. Really, you've seen the pair rally quite sharply, but if you look at the chart now, the risk is that maybe some of this momentum is beginning to wane. This daily chart is interesting, sort of faltering at that moving average. If we look at the hourly version of that chart as well, you can perhaps see that in a touch more detail, really, that over the past few days, rallies have been sold into. And I think barring some kind of really dovish Fed here, I think you might see Eurodollar weaken as the dollar continues to strengthen.
Okay, all right, Chris, thanks. We'll be back with you with a look at that trade and other markets as we approach the top of the hour. And from New York is Christopher Vecchio, Senior FX Strategist at Daily FX. Chris, what are you watching in terms of the Fed announcement?
The FOMC is gathering in Washington, D.C. today for the October Fed meeting, where it is widely anticipated that a 25 basis point rate cut will be delivered. Fed Chair Powell has a careful balancing act on his hands, weighing the de-escalation of the U.S.-China trade war against clear evidence that the U.S. economy is slowing down. Overall, market participants are expecting a dovish tone, with the next rate cut priced in by March 2020.
Okay, but let's take a look at the markets before we get back to Chris Beecham here in the studio. I want to take a look, first of all, in some more detail at this euro-dollar trade. Chris was just mentioning this, and we're at a critical level here. You can see quite clearly it's meeting the bulls and bears here the buyers and sellers. At this line of support we had earlier on this year, back in April and again in May, we have been below this, but that line is very much a line to watch. In terms of where we are in terms of some of the indices, the Dow Jones Industrial Average has been the poorer performer in terms of recent daily performance. This is the daily chart. We saw that record high at 27,402 back on the 17th of July this year. Since then, we have tried but failed. In fact, we got these lower highs. So even at 27,095, we still haven't got as high as we were, which was that high back on the 12th of September when we were at 27,340. 27,402 is the record high for the Dow. But the Nasdaq and the S&P 500 have both, in the last few days, hit new record highs. Now, I saw the Nasdaq 100, that is, not the Nasdaq Composite. Now, this is the S&P 500, and you can see a clear move up above that previous line of record high at 3,026. That line of resistance has now become support, and at we're about 5 or 6 points above that line of support at the moment for the S&P 500. So that is another interesting chart to watch as we go into the numbers at the top of the hour. Also, gold. We're getting to this point here where we are in this symmetrical triangle, waiting for the breakout. We went into it on the upside because a symmetrical triangle on the whole is a continuation pattern. If you go into it on the way up, the chances are you're going to break on the way up. We've had a couple of tries at that in the last few days, but failed. So if we do take the height of this symmetrical triangle and project that up, that would be your price target. We're currently trading at 14.93. That price target is something like around about this high we had here back on the 4th of September at 15.57. Now, some of that depends very much in terms of what's been happening with the dollar. Now, earlier in the week, my colleague Victoria Scholar caught up with Daniel Lacalle, chief economist at Tressis, and Victoria began by asking him whether 3 rate cuts from the Fed is enough.
I think it's unnecessary. I don't think that the US economy needs another rate cut. And judging by the messages about the strength of the economy that Mr. Powell gives and judging by the data, I don't think that there's any need for a rate cut. However, I think that the Federal Reserve is acting preemptively and is acting also as a reaction to a much more dovish European Central Bank, much more dovish Central Bank of China, People's Bank of China, and the BOJ. So it is very likely that he will give both messages. He will talk about the strength of the economy, the strength of the labor market, and the decent inflation data, and at the same time probably give a rate cut. So it's this new concept of hawkish, dovish Fed that we're hearing quite a bit recently.
So you do think we are going to get this rate cut? There's no chance that we won't, because it seems as though the sentiment has really shifted around the world recently. I mean, if we look at Brexit, that's one risk that seems to be subsiding a bit. Also, the trade tensions, everyone's growing in optimism towards that issue as well. Yeah,
well, I would agree that if we look at, on one side, the risks that have been perceived by markets and the way that markets have behaved, added to the macro data itself in the United States. You saw the manufacturing index in expansion, services index in expansion, also quite good. The jobless claims was actually better than expected. Inflation remains above the 2% core inflation, 2% level. Therefore, none of the data in the United States is justifying a rate cut. However, it does look very much like the Fed does not want to be strengthening the dollar for no purpose, and that therefore a rate cut is more a reaction to an incredibly and misguidedly dovish ECB, in my opinion, rather than what is happening in the United States economy.
So we're going to get this rate cut, but what happens next with rates? What does the Fed do next? Does it just stay on hold for a period of time, and how long could that be?
Well, what I would think would be the right thing to do would be to remain closer to the curve than the Fed is right now. And likely also, considering what we have seen in the repo market and the challenges of liquidity that we see in the US economy, is to stick to addressing those issues rather than just cutting rates for no reason, particularly when there's no need. No? So however, it does look like the Fed wants to look like it's not hawkish relative to other central banks. This is all relative, obviously, because it is not being hawkish. But I think that what the Fed should do should be to address the liquidity issues of the repo market, but do it with a very clear time frame so that it does not become a hidden QE. Second is to maintain rates closer to the curve, and second is to pay a lot more attention to the risk of bubbles in the financial market.
So on the financial markets, obviously in terms of the US dollar, we've had this massive bull run really since the start of 2018. We've seen a little bit of a pullback recently. You alluded to the fact that the Fed doesn't want to strengthen the dollar for no reason. I mean, where do you stand on the outlook for the greenback? Do you think it's got more room to run?
I think it has. And the reason why I think it has more room to run is because we have massive maturities coming from emerging markets in US dollar denominated debt, added to a weakening level of reserves, as well as weakening dollar revenues from commodity sales. So that in itself creates a larger demand for dollars than probably many have in their minds. Additionally, the extremely dovish attitude and policy of the ECB, of the European Central Bank, is also in essence a call to buy dollars. So I think that as the growth in the economy, in the global economy, starts to reflect the reality of at least stagnation that we see in some economies, and we see as well that there's a rising demand for dollars from emerging markets, then I would continue to be quite happy with a strong dollar relative. Again, we're talking the DXY here. The XY index is clearly showing that it's not necessarily that the dollar is strong, is that the rest of the currencies are weak. And what we are seeing in emerging markets in Latin America is pretty evident, and we should pay a lot of attention to that growing demand for dollars from the massive maturities in US dollar denominated debt, both at the public and private sector.
Okay, about 3 minutes to go until the announcement at the top of the hour. Let's get back to Chris Beecham very quickly and take in what you were saying earlier about this euro-dollar trade. If pushed, I know you said the potential is for a short going into this, but of course it depends on what happens at the top of the hour. You're also watching dollar-yen.
Yes, I think dollar yen also remaining fairly interesting. If you think the dollar will strengthen, because there's not much the Fed can say, then dollar yen finds itself at a fairly critical point, really. We're doing our best to try and break higher over the last few days with dollar yen back above 109 and not succeeding. So is this the moment it finally arrives, really? The 200-day moving average there, trying to get through that. 109 is the high from July and August. If it does move through there, and you can see it's been steadily gaining ground since August, then you think arguably there is a chance of further upside there. You've got a nice crossover there, the 50-day crossing over the 100-day, or poised to anyway at the moment. I suppose the one risk is that MACD looks a touch overextended. I think momentum could be building for this one if the Fed delivers in the way that we think they might, and the signal that there isn't much more they can do at the moment, and certainly perhaps the macro outlook looks fairly benign at the moment, and with the lessening of trade wars also perhaps boosting the appeal of the dollar. When you get a dog wagging its tail, I mean, we've got here the dollar moving, and what happens to gold is quite often the opposite. You've just set up two trades here potentially where you've got money going into the dollar. Does that mean you're short gold? Yeah, you've rather pinned me to that one. I think the logic you have to stick with, of course, is that gold might suffer if the dollar continues to strengthen, because the Fed's outlook for inflation is key. Gold has defended the 1485 area the last few days. Really, it's been not doing very much at all on the back of a very strong rally, but I think it's still one to watch here, really. As you point out rightly, there's an interesting triangle formation that could be setting us up quite nicely, really. Certainly the direction of travel over the past year or more is higher for gold. Okay, all right, Chris, stay with us. We're awaiting that decision in precisely 1 minute's time. Just want to quickly return once again, if I can, to take a look at the trade that I want to have up when we see this decision. This is the euro dollar, and what we're going to do is we're going to go down to take a look at the minute-by-minute trade going into this, and that's the euro dollar trade as we await that decision. And the other side of this, and to
to some degree, this is a trade which really is basically euro-dollar, but round the other way, this is the dollar basket. It's because euro-dollar is such a big part of this. But just for the explanations, the direction of the dollar, I'll keep an eye on that as well. But just to take a look in some more detail about the announcement that we're expecting in 20 seconds' time, we are expecting the Fed to cut interest rates by a further 25 basis points. But it really is all about what the Fed then does and what it does going into the back end of this year, and how it tries to defend itself as well from the commentary that we've been seeing and witnessing and hearing from Donald Trump as well on what's happening. Right, here we go. This is the euro-dollar trade minute by minute. You can see money coming out of the euro. Chris was talking about a short position on here, and this is working out neatly as we go into this. We're off the lows in this minute's trade. We're trying to get some details. They have cut interest rates, I think, as expected. Let's look, if we can, at some of the headlines that we are looking at the moment. The Fed, we're waiting on the statement as well. In half an hour's time, we get details of what's been happening in terms of the statement that the Fed has got with this. And we continue to witness this money coming out of the dollar and, I beg your pardon, coming out of the euro and into the dollar. So it cuts its interest rate by 25 basis points to a range of 1.5 to 1.75. Now, interesting enough, today, we've seen the Bank of Canada keep interest rates at 1.75%. And this is an interesting trade. This is the first time we've seen the Fed funds rate in the States drop below the Canadian benchmark interest rate since December 2016. The Fed cuts its target interest rate, as we've been hearing. It votes in favour of the policy with 8-2. George and Rosengren wanted no change in interest rates. So they're the hawks on the voting committee. And so 8-2 with 2 dissents on that decision to cut interest rates by 25 basis points. In the change to wording, the Fed says it will continue to monitor incoming information as it assesses the appropriate path for the federal funds target rate. And business, fixed investment and exports remain weak. The Fed says. The Fed repeats that the labour market is strong, economic growth rising at a moderate rate. The Fed repeats that job gains have been solid, unemployment has remained low. This is another thing that the Fed's got to contend with, and that is the overall picture of the economy, and the fact that we're looking at the Fed, the unemployment rate at 3.6%. And in an environment like that, normally you would see wages go up and some sort of inflationary spiral coming through in wages, but that really hasn't taken hold. We will get further evidence of that on Friday when we get the non-farm payroll data out at 12:30 p.m. UK time. Chris, anything there you've seen that, Chris Beecham, anything there you've seen which sticks out to you as something that we should be watching that we didn't already know, or that comes as a surprise to these markets?
It removes the phrase act as appropriate, I think, is the interesting thing. So there's a sort of hint that that is it for the time being. So do watch out for reinforcement of that from Powell at the press conference, of course, as a sign that maybe they are quite happy to do anything more, but not at the moment, really. Overall, I think it's a fairly standard update. Nothing much to say, really, on this front. But it's definitely one I think that they need to back up the idea now that we have a very much a Fed that's back in wait-and-see mode now for the next.
Yeah, this is a chart we've got here at the moment up on the screen, which is the dollar-yen. And as Chris was saying, with this money going into the dollar, which is exactly what we've seen, bearing in mind this is a minute-by-minute chart. So when you look at the daily chart, there really is not very much move. So we don't really have anything which is wildly out of target range from the economists we've been talking to and what we were expecting. The fact is that rates have gone down to that band between 1.5 to 1.75%. Let's bring in Chris Vecchio from New York from Daily FX. Chris, anything that you've seen which sticks out? I mean, Chris Beecham has run through some of the headlines that we've got. Anything you want to add in terms of where we are and the likely market reaction after this?
Sure thing, Jeremy. Thanks for having me on again. The U.S. dollar right now is struggling to gain some traction here after what would perhaps be considered a little bit more hawkish of a FOMC statement. 2 dissenters plus a pause in the rate cut cycle runs counter to the narrative that we could see another Fed rate cut perhaps as early as January or March 2020. But at this point in time, I think everyone's hanging their hat on the commentary from Fed Powell. As we know in the past, Chair Powell's commentary during the press conference has been so much more important than what the rate decision itself was. So at this point in time, I think that the dollar is still in a precarious position, currently trading at 97.75. The throes of a longer-term bearish rising wedge off the February 2018 low still remain in place. On the other side of the equation, we take a look at gold right now. It has fallen back within the confines of its bull flag. Whether or not we can see sustained elevation from this point forward will be crucial from a technical perspective as we challenge the intramonth uptrend off of the October lows.
Staying on that gold chart, just very briefly, Chris, I was talking to Beecham here in the studio about that symmetrical triangle that's building up there, waiting for a breakout. But overlaid on that, you've got a nice channel. Do you think that we are now expected to continue that channel down or break up out of it?
Right. So if we were looking for a topside breakout, the level that I have defined as my confirmation level would be the October 3rd high, $19.53. You can see that previous attempts to get through that level back here, the early part of the month on October 10th, we produced a bearish outside engulfing bar. Again, just a few days ago here at the end of last week on Friday, we put an inverted hammer on the chart. Neither of those highs breached that October 3rd high. So I'm not going to feel comfortable or confident that this bull flag is actually gaining traction until we do see $15.19.53 on a closing basis. For now, I am concerned that the attempted breakout last week is setting up a false breakout scenario. If that's the case, we should be on alert for a swing lower within the channel. If we do find ourselves trading below last week's low at $1,480.73, I think we'd be looking at a much likely scenario, a higher probability that we would see a return back to support within this descending channel or bull flag. And that could come closer towards 1420 over the next several weeks.
Yeah, okay, that's an interesting call. I just want to take a look, if I can, and ask you to bring up a chart of dollar yen. This is something else that we were looking at here in the studio. We've got, well, money going into the dollar, basically. If you look at a minute-by-minute chart, it's off the highs at the moment, but I mean, broadly speaking, the dollar's been supported. But I notice actually on my chart, I've got a 200-day moving average capping us out. What are your thoughts on dollar yen? Is the upside limited against the yen, or do you think there's more upside to come for the dollar against this Japanese currency?
You know, I think dollar yen is in a really tough situation right now. Around Fed meetings, around U.S. non-farm payrolls report, dollar and yen tend to pull in opposite directions. What's good for the dollar, a very strong employment report, a hawkish Fed, isn't necessarily good for something like stocks. And so as the prospect of the relative appeal of, say, the S&P 500 dividend yield is decreasing relative to a rising U.S. Treasury yield, investors are less likely to hold on to those higher risk positions. And so you have a balancing act here. What's good for the dollar tends to be bad for stocks. That increases demand for the yen. It's really on the reason why on days like today, around non-farm payrolls on Friday, I prefer to look at other yen crosses rather than dollar yen itself.
What sort of crosses are you talking about then that you prefer to look at?
Sure. Historically speaking, given the proximity of the Canadian economy to the U.S. economy, a CAD yen to me tends to be a little bit more interesting around U.S. Data releases like non-farm payrolls or GDP, given the implications for the Federal Reserve. I think right now Euro yen is fairly interesting to keep an eye on. Unfortunately, the best yen cross, historically speaking, the most volatile yen cross, is pound yen. But as we know, there's a lot of interference from Brexit and the upcoming general election. So that's not a pure risk-on, risk-off type of instrument right now.
That's an interesting point. I was talking to some of your colleagues here in London about the Bank of Canada's interest rate decision today. As I said in the show earlier on, that we had the move today where we saw the BOC stay at 1.75%. Here we are now with the Fed for the first time in, 4 years or so, since we've seen the federal funds rate below that of the Bank of Canada. Is there any significance to be taken out of that? I'm looking here actually, if we can bring up a chart of my dollar CAD. You can see actually on this daily chart, there's a lot of money today going into the dollar over the Canadian dollar. And in fact, if you look at a very long-term chart, it's interesting that technical analysis, you know, it works if you want to make it work, of course, but it is being supported by a long-term line on dollar CAD. Any thoughts on the relativity between the two interest rate decisions today?
Sure. You know, in the last 48 hours, dollar CAD's technical picture has changed dramatically. Yesterday, we saw prices pushed to a fresh monthly low, but then we closed above the previous day high. And that's notable because that's what's known as a bullish key reversal. And a bullish key reversal is typically a bottoming candle. And so today we've seen significant fall through to the top side. The juxtaposition between expectations for the Fed and the BOC has really dramatically shifted in the last 48 hours. 48 hours ago, the Bank of Canada was perhaps the central bank that was least dovish among all of the major central banks. No rate move priced in through at least September 2020, whereas the Fed had lined up a rate cut for today, had a rate cut lined up for either January or March 2020. Now all of a sudden, the BOC is coming out and saying, you know what, the economy is not doing as well as it appears, and the Fed's also saying they're not going to be looking to cut rates again so quickly. So what had been a fairly one-way street for the BOC and the Fed in the last 48 hours has really been flipped on its head. Now the juxtaposition is that the BOC looks like they're actually going to be getting a little bit more dovish than previously anticipated, and the Fed will not be. So in the near term, after this very strong run by the Canadian dollar in the first several weeks of October, there may be now a round of profit taking here.
Okay. Look, Chris, we'll leave it there, but thanks indeed for your time, as ever, taking us through some of those charts in the wake of the interest rate decision there from the Fed. Let's bring Chris Beecham back into the discussion. And away from the foreign exchange markets and the effects on gold and so forth, let's bring it round to equities. As you rightly pointed out before we went live, we got Facebook tonight. And we've seen a lot of money going to techs recently. I know you're watching the S&P 500, and like the Nasdaq 100, we've seen record highs for the S&P, the broader market index.
We have, and I think it's important to note now that, of course, we're on to the press conference now for Jerome Powell, and it's worth noting that Powell has a very bad record for the S&P on Fed days. Usually he gets away with it in the decision, and the press conference says something that gets everyone into panic. You can look back to March, the end of April, June, end of July as well, particularly egregious examples of where the market then sells off in the wake of the press conference. So this year has been a very tough one for the bulls in the wake of these, although it has been known to set us up for decent buying opportunities further down the line. Of course, as you rightly point out, where do we go with markets at record highs? What is the real kicker here that can drive us higher? Is maybe there isn't one. Maybe there's just a sense of things are ticking along quite nicely. Trade wars should be resolved in due course, or at least progress on that front, and we can escape that. But it will be interesting to watch. I think perhaps the one we're hoping for is it's a bit like March, where you got a sell-off into towards the end of the month, and then it began to rally and recover. And of course, from this point onwards, seasonality is still very strong for the S&P. I talk about it endlessly, I know, but it is something that's worth looking at. And usually, if we've had such strong performance so far this year, the rest of the year, all 2 months of it left, should also be fairly strong. So any weakness, I think, in the wake of the press conference would still, I think, set us up quite nicely for you.
Yeah, this is the minute-by-minute chart for the S&P 500 as we took that decision. We've seen a move up now to 30.34. And as Chris was saying, very difficult to look at this chart and work out precisely where it's going to go. You can see, actually, if you look at the daily chart, a little bit of a pullback, but nonetheless, there doesn't seem to be too much let up in the appetite for these stocks. I mentioned the fact that Facebook is due out with earnings. There's a number of companies in the tech space either having come out or due to come out with earnings. This is the Nasdaq 100. Again, similarly, we got the previous record high here of 8,035. Now resistance up until the end of trade at the back end of last week, and since then it's now become support. We've seen a little bit of an effort to try and get below that today, but it really does depend very much on the big behemoths of Facebooks of this world, Amazons, Apples and so forth, what they report. And it's been a pretty good reporting season actually, I think, Chris, hasn't it? I think on the whole. When we measure this, we measure it against a set of benchmarks that are produced by people like you and me. We look through numbers every single day of the week. The bottom line is, I guess, they've undershot their expectations for this earnings season. Yes,
expectations were pushed down, but if you look at how things are doing thus far, and remember, we're around halfway through earnings season for the S&P, but I think the figure as of Monday was that around 73% of companies had beaten expectations. It's the best performance in over 10 years. Now, you might say, well, that's because expectations were so low, and that's fair enough. But nonetheless, markets are forward-looking. The old cliche still holds true. And if they continue to beat these expectations, if they issue fairly rosy guidance about the outlook, then I think you could start to see the earnings picture in the US improve significantly, which should drive equity markets higher. And the interesting thing to note at the moment is you're continuing to see these huge outflows from equity market funds, billions of dollars still leaving these mutual funds, these ETFs, and going into bonds or cash. What happens when that reverses? Are we seeing maybe the tail end of another consolidation period in equities from 2018 to the end of this year, and then we start to move into another leap higher for the bull market, which I still think is quite possible at this point in time.
Yeah, okay, so this is the Dow Industrials, not quite as high as we were back in September, and again, not as high as we were when the last record high came through at 20,402. Just to, for the completeness of the picture, just go into the 1 minute chart just to show the way in which we've seen money going into these equity markets since we've had this. And of course, Chris, we mustn't forget when looking at these charts on equity indices, there's not a particularly good backdrop. We still haven't got a resolution to the trade tariff issue between the US and China. There's some sort of visibility potentially if we get these two economies together again to talk about this. But also there's the impeachment concern and where US politics is going. And well, I mean, what else do you say? I mean, it is amazing how companies continue to churn out good numbers in the face of what potentially might be something that might otherwise have caused problems.
Yeah, but trade wars, the impeachment, yada yada, it's all the sort of the noise that goes around it. Look at the fundamentals, look at the earnings flow, look at the direction of travel for the economy, and that's still reasonably solid. It's not incredible. 1.9% GDP is not the greatest America has ever seen, despite what the president would like to say, but it is still a fairly solid number, and earnings season is still going relatively well. We're seeing improvement here. Even maybe things are looking up in Europe as well, and perhaps everyone just has got a bit too bearish once again. The assumption is that things will get a lot worse, and yet despite all of this, the S&P, it's still record highs this week, even as trade wars continue to drag on. Yes, they could be the thing that sinks this bull market. It would not be surprising if they were, but it's held up impressively, and yes, the Dow still yet to get back to those record highs, but I would not be surprised. I'd happily make a bet with you that by the end of the year we will see more record highs on the Dow by the end of the year, and we can catch up on that one at the next Fed Live.
Yeah. Let's just quickly expand it out and open up the horizon a bit. You mentioned Europe. Things are not perhaps maybe as bad as they were. 1st of November, of course, brings a new guard. Excuse me, forget that. That must be at the back of my mind. Christine Lagarde comes in, and the new leader of the pack for the ECB. What she's going to bring remains to be seen, but she is not a deep numbers type economist, is she? She's big picture. She comes from a French political background. Be interested to see what her tenure brings, but nonetheless, you say it's not quite so bad in Europe, but let me just quote you the fact we've got record debts, we've got QE back again, we've got negative interest rates that Donald Trump's referred to. There are a lot of concerns about what's going on here, but they're pumping money in. Is that not what's supporting the markets?
Not particularly, no. I think European markets have been such underperformers versus the US if you looked over the last few years. And yet the DAX rocketing higher once again. Maybe, again, everything just assumes that things will get a lot worse. But you've seen this impressive recovery here, higher highs all the way through the year. It's had its tough 2018. And thus far, the DAX has been resolutely solid throughout the year. I think there's a lot more to be said for European markets. And maybe their time has come now. I think, yes, you could be concerned about parts of Europe, but if Lagarde is there to be the diplomat, not the economist, she might be the person that can persuade European leaders to finally open those fiscal spending taps, which is the thing Europe needs to get things moving once again.
Okay, you've been commenting today along with Josh Mahoney about sterling in the wake of that announcement last night. We're going to go into another election at the back end of this year. What's the call around sterling? What are you telling clients about what's happening with the sterling trade at the moment in the wake of that decision last night and the prospect for 6 weeks of nothing from parliamentarians?
A horrendous uncertainty to go with it. Either you have a Conservative leader who is firmly pushing ahead with this hard Brexit deal that he has, and that's what it is, of course, or you have a Labour leader who is devoted to things like nationalisation of key industries and undoubtedly higher tax rates. So I think it would not be surprising to see sterling continue to weaken in the short term. I think you've seen, though, quite an impressive recovery here, and I think there's perhaps a bit more to come as well, really. Optimism that some kind of Brexit deal at least removes that key uncertainty. And I don't think Jeremy Corbyn will be Prime Minister come the 13th of December. It seems unlikely, given the way the numbers are falling. Likely that Boris Johnson remains PM. Maybe not with a huge majority, maybe enough just to get this deal through and remove the problem that Brexit has, at least in the short term.
You're in good company. John Ashcroft was sitting in that very seat today. He's the Saturday Economist. He was saying exactly the same thing. So I think it tends towards that side politically. But nonetheless, it'll be interesting to see what happens. We've got that extension till the 31st of January. Chris, thanks indeed for your time. Chris Beecham, a Chief Market Analyst here at IG. And you can catch up with Chris with more on his Twitter handle. Now, also don't forget to listen to our IG Trading the Markets podcast. In our latest series, we're focusing in on the cannabis industry. In the first episode, I spoke to John Cooper and Samantha Myers from Gowling WLG about the opportunities for investors in the UK cannabis market and whether the UK government will follow Canada's lead with deregulation. To find out more, search for IG Trading the Markets podcast on IG.com, iTunes and Spotify. And also just a quick teaser as well to Friday, just a reminder that the non-farm payrolls data out at 12:30 p.m. UK time on Friday. Non-farm payrolls along with the average hourly earnings, the unemployment rate and so forth. And my colleague Victoria Scholar will be live from 12:25, 5 minutes before the announcement, with Peter Dixon from Commerzbank. He'll be joining us with his view on how things look to him in terms of the US economy in the wake of this slightly hawkish statement out tonight. In 10 minutes time on the Federal Reserve website, you'll be able to catch up with the publicly available press conference that Chris was talking about, where you get some more flesh on those Fed bones. The next Fed meeting is on the 11th of December. That's all we have for you today. I thank you once again to our guest Christopher Vecchio from Daily FX in New York and Chris Beecham here in London from IG.